We begin with Chapter 6. In this chapter, we will analyze in detail the short call position. The short call position is used when the market outlook is bearish or neutral. The strategy consists of selling a call option. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contract, and besides, the values do not include brokerage commissions. The maximum profit on this strategy is limited. The most we can make is equal to the premium received multiplied by the number of shares. On the other hand, the maximum loss that we are exposed to is unlimited, because the increase in the stock price has no limit. So be very careful with this, because with this strategy, we are exposed to a loss that can be very large. The break-even point is equal to the strike price of the option plus the premium received. The break-even point defines the profit and loss zones. In our case, for stock prices lower than the break-even point, we are in a profitable situation. In contrast, for stock prices higher than the break-even point, we are in a losing situation. Continuing with the analysis, the amount of initial margin depends on the broker. In some cases, it can be very large. An increase in volatility hurts the position. Time decay helps the position. With respect to exit conditions, to close the position, we must buy the call. If the stock price is lower than the break-even point, we are in a profitable position. Otherwise, we are in a losing situation. When we open a short call position, we become the writers of the call option that we are selling. Therefore, as the writers of the option, we assume the obligation to sell shares of an underlying stock at a specific price for a predetermined period of time. When we open a short call position, it is said that we are selling a naked call. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at the time of call sale. As we get closer to call expiration, the curve of profits and losses is like the one shown in green. And finally, at call expiration, the curve of profits and losses is the one shown in red. We can see that as time passes, the value of the break-even point increases. Notice how it moves to the right. And as the value of the break-even point increases, the range of prices for which we are in a profitable situation increases. Therefore, in this case, time decay helps the position. Let's see an example of how this strategy works. Here we are seeing the stock chart of the Amazon company. As we can see, on February 14, 2011, the company gave us a clear bearish signal because the stock touched resistance, and this was accompanied by a decline in volume and an RSI above 70%. As we said, on Monday, February 14, 2011, Amazon gave us a clear bearish signal. In order to take advantage of that, suppose at that time we had decided to sell call options. At the close of that day, Amazon was trading at about $191. So we could have sold 10 calls with a strike price of $195 and expiration in February 2011 at a premium of $1.10. Thus, we would have received $110 per contract, that is, $1,100 overall. In a short call position, we must consider that as we become the writers of the options, we can use time decay in our favor by selling the contracts with the shortest time left to expiration, which are known as front-month options. In our case, the options were expiring on Friday, February 18, that is, in less than 5 days. We must also consider that a margin of approximately $35,000 would have been required to open the position. This amount depends on the broker. The next day, the stock price started to fall. On that day, the stock closed at $189 after trading between $188 and $190 during the session. That can be seen here. We sold the calls on February 14, the day we got the bearish signal, and the next day the stock fell and closed at $189. At that time, the premium of the contracts was 30 cents, so the 10 contracts would be worth $300. If we had bought the contracts at that time, we would have made a profit of 80 cents per share, because we had sold at 1.1. Thus, we would have had a total profit of $800, making a 73% return on investment in only one day. After February 15, the stock continued to fall until it closed at $186.5 on expiration Friday, February 18. It is important to mention that we can close a short call position by buying the options we sold any time we want. In a short call trade, and in any options strategy, there is no need to wait for the option's expiration to close the position. As we had said, after February 15, the stock continued to fall until it closed at $186.5 on expiration Friday, February 18. At that time, as our contracts had expired out of the money, that is, worthless, we would have made a profit of $1.1 per share, that is, the entire premium received. Thus, we would have had a total profit of $1,100, making a 100% return on investment in less than 5 days. Here we can see the numbers of our example. The strategy consisted of selling 10 Amazon calls with a strike price of $195 and expiration in February 2011 at $1.1. Therefore, our investment is equal to 1.1 multiplied by 100, which is the price of each contract, multiplied by 10, which is the number of contracts sold. That is a total of $1,100. This money is credited to our account. The initial margin depends on the broker. In this case, it would have been about $35,000. Actually a very high value. That is why sometimes the amount of margin can be so large that it makes the trade unprofitable. This could be the case. The maximum profit we can make is equal to $1,100. That is, the entire premium received for the options. On the other hand, the maximum loss that we are exposed to is unlimited, because the increase in the stock price has no limit. The break-even point is equal to the strike price plus the premium received. In our case, 195 plus 1.1, which is equal to $196.1. Here we can see the order we must enter to open the position. It consists of selling 10 Amazon calls with a strike price of $195 and expiration in February 2011. In the side column, we select the action Sell to indicate the sale of options, and in the Position Effect column, we select the option To Open to indicate that we want to open a new position. The entered price is $1.1 and the order type is limit. That is, we want to sell the options at a minimum price of $1.1. Here is an example of the order we must enter to close the position. It consists of buying the 10 Amazon calls that we had sold. In the side column, we select the action Buy to indicate the purchase of options, and in the Position Effect column, we select the option to Close to indicate that we want to close an existing position. The entered price is 30 cents, and the order type is Limit. That is, we want to buy the options at a maximum price of 30 cents. In the case we hold the position to expiration, if the options expire out of the money, that is worthless, we do not need to enter any closing order. Here we ended with the chapter Short Call. In the next chapter, number 7, we will analyze in detail the covered call strategy.